Markets are volatile. One day they surge, the next day drop, and that can make investing feel like a gamble. I'm Khalstian, founder of EKH Capital. I break down companies and long-term investing strategies to share how I approach stock analysis, not financial advice. Today, we're breaking down one of the most common and widely used strategies to navigate market ups and downs. It's called dollar cost averaging. Let's explore how it works and whether it really makes a difference. Dollar cost averaging, or DCA, is a method where someone invests a fixed amount of money on a regular schedule, regardless of what the market is doing. For example, putting in $500 every month into an ETF or index fund. When prices are high, you buy fewer shares. When they're low, you buy more. Over time, this strategy helps smooth out your average cost per share, especially in volatile markets. It's a simple way to stay consistent and avoid trying to time the market. Timing the market perfectly is extremely difficult, even for professionals. Dollar cost averaging is often used by people who want to remove emotion and guesswork from their investing process. It also aligns well with how most people earn. They get paid monthly or bi-weekly and can invest consistently over time. And during market downturns, DCA automatically puts more capital to work when prices are lower, potentially turning volatility into an advantage. But does dollar cost averaging actually work? Now let's be clear, dollar cost averaging is not guaranteed to outperform lump sum investing. In fact, historical data shows that lump sum investing tends to come out ahead in the long run because markets generally rise over time. But here's the nuance. DCA isn't just about maximizing returns. It's about managing risk, staying disciplined, and reducing the emotional impact of market swings. That's why many people use it for retirement accounts or automated contributions. It removes decision fatigue and helps them stay consistent. For what kind of investors does DCA make sense? Dollar cost averaging might fit best for long-term investors who want consistency, people who prefer automation, and anyone looking to reduce emotional decision making. It's not a better or worse strategy. It's about fit. It can be one way to keep investing without being overwhelmed by market noise. Dollar cost averaging isn't a silver bullet, but it's a strategy that's helped many people stay committed to their long-term plans without the stress of market timing. Remember, this isn't financial advice, just a framework to help you think more clearly about your investing journey. If you found this helpful, be sure to like and subscribe. And let me know in the comments, do you prefer to invest all at once or spread it out over time? I'm Khalstian and this is EKH Capital, where we empower your investment journey.